A family loses everything in one generation. Another family, holding a comparable fortune, is now 4 generations deep and quietly larger than when it started. Same tax code, same stock market, same access to lawyers. The difference isn't luck, and it isn't a secret Swiss vault. It's architecture, a deliberate structure of trusts, entities, and unwritten rules built to survive the 3 things that kill fortunes: taxes, lawsuits, and heirs. There's a number that gets thrown around constantly in this conversation, that somewhere between 70% and 90% of family fortunes don't survive to the 3rd generation. You'll hear it cited as gospel. It's worth flagging up front. The methodology behind that figure has been challenged by wealth researchers. The sample sizes in the original studies are small and non-representative, and survive is defined inconsistently across the sources that quote it. We'll come back to why the number persists anyway, because whether or not the statistic is exactly right, the pattern behind it is real, and old money families have spent centuries building specific countermeasures against it. This is not a video about vibes, quiet luxury, or looking expensive. This is a mechanism-level breakdown of the actual legal, financial, and structural tools the wealthiest families in history have used to protect capital across generations, and the boring, unglamorous discipline that won the 3-headed threat. Before we get to the tools, we need to understand what old money is actually defending against. There are exactly 3 forces that dissolve multi-generational wealth, and every structure we'll discuss in this video exists to blunt one or more of them. Threat 1. Taxation. Particularly at the point of death, estate and inheritance taxes are, structurally, the single largest scheduled event that can transfer a fortune out of a family and into the state. In the United States, the federal estate tax has historically sat as high as 55% on assets above an exemption threshold. A family with no planning that simply lets an estate pass through a will, unprotected, can watch a third to more than half of it evaporate the moment the founder dies. This is not a fringe risk. It's the single most predictable, most heavily litigated, most extensively planned around threat in all of wealth preservation. Threat 2. Legal liability. Lawsuits, creditor claims, divorce settlements, and business failures can each individually claim a fortune that taxation never touched. A single judgment, a single failed venture, a single contentious divorce without a prenuptial agreement can dismantle in months what took decades to build. Old money families treat litigation risk not as a hypothetical, but as an actuarial certainty across a long enough timeline. Someone in the family, at some point, over enough generations, will be sued, will divorce, or will fail at a venture. The question isn't whether it happens, it's whether the fortune is exposed when it does. Threat 3. And this is the one almost nobody talks about. The heirs themselves. Money doesn't disappear only through taxes and lawsuits. It disappears through mismanagement, through entitlement, through heirs who never develop the financial literacy or psychological discipline to steward what they inherited. This is the threat the shirt sleeves to shirt sleeves in 3 generations idea is actually pointing at, however contested the specific percentage. The founding generation builds through scarcity and discipline. The 2nd generation often remembers that discipline, having watched it. The 3rd generation frequently inherits only the money, not the memory of what it took to build it. And that's the generation where the erosion tends to concentrate, according to family wealth researchers, even though the exact statistical rate remains disputed. Old money's entire structural response, trusts, entities, education systems, governance, is built to answer these 3 threats simultaneously, not sequentially, simultaneously. A trust that defeats estate tax but does nothing to prepare the heir who receives its proceeds has only solved 1/3 of the problem. If you want the actual mechanics behind generational wealth, not the aesthetic, the architecture, hit subscribe now. This channel breaks down exactly how these families operate, one structure at a time. 2. As a trust. Wealth's load-bearing wall. If there is one tool that separates old money from new money, it's the trust. Specifically, the irrevocable trust. and more specifically still, the Dynasty Trust. Here's the basic mechanism. When a wealthy individual dies owning assets outright, those assets are included in their taxable estate and subject to estate tax. But if those assets are placed into an irrevocable trust, meaning the person permanently gives up ownership and control, transferring both to the trust itself, governed by a trustee, under rules the grantor sets in advance, the assets are no longer legally owned by that person. They can't be taxed in that estate. And critically, they can't be reached by that person's creditors or lawsuits either, because the person no longer owns them. The Dynasty Trust takes this a step further. In jurisdictions that have abolished or extended the rule against perpetuities, a legal doctrine that historically forced trust to terminate after a set period, usually measured in a human lifespan plus 21 years, a trust can now be structured to last for centuries or indefinitely. States like South Dakota, Nevada, and Delaware have become magnets for exactly this kind of trust formation, competing aggressively to offer favorable trust law, minimal state taxation on trust income, and strong privacy protections. What this means in practice: a fortune placed in a properly structured dynasty trust can, in principle, be transferred to children, grandchildren, great-grandchildren, and beyond, for generation after generation, without ever being subject to estate tax again at any of those transfer points. Because the assets never re-enter anyone's personal estate, the wealth sits inside the trust structure indefinitely. Heirs receive distributions and often benefits like housing, education funding, or business capital. But they never technically own the underlying assets outright, which means when they die, there's nothing in their name for the estate tax to apply to, and nothing exposed if they're sued or divorced. This is the mechanism behind families like the Rockefellers, maintaining structured wealth across 7 or more generations. The original Rockefeller fortune, built in the late 19th century through Standard Oil, was substantially placed into structures, trusts, and the Rockefeller family office apparatus, specifically designed to survive the founder's death without triggering catastrophic tax exposure, and to insulate the assets from the individual liabilities of descendants who would never personally run an oil company. The Rothschild family, operating across multiple European countries from the early 19th century onward, used a related but distinct structural principle, keeping controlling ownership of the family's banking interests concentrated within the family through careful marriage alliances and partnership structures that functioned in effect like an early trust, control and benefit, flowing to family members, ownership structurally insulated from any single member's personal risk or any single country's tax and inheritance regime. There's an important nuance here that separates sophisticated planning from naive planning. A trust only works if it's genuinely irrevocable and genuinely controlled by an independent or quasi-independent trustee. Families that try to have their cake and eat it too, creating a trust on paper while the grantor continues to informally control every decision, expose the entire structure to legal challenge. Courts have unwound sham trusts precisely because the grantor never actually relinquished control. The discipline of true irrevocability is what makes the tax and liability shielding legally durable. This is a legal and jurisdictional area with significant nuance, and any family considering this kind of structure needs qualified estate counsel. This video is describing historical and structural mechanisms, not offering personal legal advice. 3. The family office, a private financial government. Once a fortune reaches a certain scale, old money families stop using banks and wealth managers the way ordinary people do, and instead build what's called a family office, essentially a private, dedicated organization that exists to manage exactly one family's wealth across every dimension: investing, tax planning, legal structuring, philanthropy, real estate, even household staffing and security. There are 2 basic forms. A single family office serves exactly one family and is typically justified once a fortune reaches the several $100 million to $1 billion range, because the fixed cost of hiring dedicated investment officers, tax attorneys, and administrators only makes economic sense at that scale. A multifamily office serves several wealthy families simultaneously, sharing the overhead, while still providing much of the same specialized service, and is the more accessible entry point for families with tens of millions rather than hundreds of millions. Why does this matter for wealth protection specifically? Because a family office does something a retail bank or a standard financial advisor structurally cannot. It centralizes information and decision-making in a way that makes sophisticated, coordinated structuring possible. A retail wealth manager sees your brokerage account. A family office sees the trusts, the real estate holdings, the private business interests, the insurance structures, the philanthropic vehicles, and the individual family members' financial behavior all at once, all under one coordinating strategy. That's what allows for the kind of integrated planning where a business sale is timed against a trust funding event, which is timed against a charitable deduction, which is timed against an heir's education trust distribution. In the United States, family offices meeting certain criteria can also qualify for an exemption from registering as investment advisors under the Investment Advisors Act, the so-called family office exemption, formalized after the Dodd-Frank reforms. This exemption matters enormously for privacy, because registered investment advisors are subject to disclosure requirements that would otherwise expose significant detail about a family's holdings and strategies. A properly structured family office, exempt from that registration requirement, operates almost entirely outside public view. This is the Kuhnen, structural backbone behind the modern operations of families like the Rockefellers, whose family office, one of the oldest and most established in the world, has managed the family's diversified interests for well over a century, evolving from an internal office managing oil-derived capital into a full, multi-generational financial institution serving dozens of family branches. It's worth being precise about scale here, though. The family office model is not something available to the median wealthy family. It represents a threshold-crossing tool, generally only economically rational, above 8 or 9 figures in investable assets. For families below that threshold, the multi-family office and, further down the scale, coordinated private banking relationships fill a similar but less customized function. 4. Insulating the fortune from the marriage, the lawsuit, and the business failure. Estate tax planning gets most of the attention, but old money families spend equal energy defending against the threats that can strike at any point in a lifetime, not just at death. The prenuptial agreement is the most obvious of these tools, and old money families treat it not as an insult to a spouse, but as a basic, expected, non-negotiable administrative step, closer to signing a lease than making an accusation. In families with generational trusts, the prenup typically isn't even primarily about the individual's personal assets. It's about clearly establishing that trust assets and inherited wealth remain separate property, outside the marital estate, regardless of how long the marriage lasts. Postnuptial agreements serve the same function for marriages that began without one, often introduced at a point of financial transition, like the funding of a new trust or a business sale. Limited liability entities serve a parallel function against business and lawsuit risk. Rather than owning real estate, business interests, or investment portfolios directly and personally, wealthy families typically hold each significant asset inside its own separate legal entity, an LLC, a limited partnership, or in more complex structures, a series LLC that segregates even sub-assets from one another within a single filing. The logic is straightforward. If a lawsuit arises from one property or one business venture, the plaintiff can generally only reach the assets inside that specific entity, not the family's other holdings, and not the family's personal assets, because the entity, not the individual, is the legal owner being sued. Family limited partnerships add a further, more sophisticated layer, historically used heavily in estate planning. A family limited partnership allows a founding generation to transfer economic interests in a business or investment portfolio to the next generation at a discounted valuation for tax purposes, because a minority, non-controlling interest in a partnership is worth less on paper than direct ownership of the same assets due to lack of control and lack of marketability. This valuation discount, when properly and defensibly structured, can meaningfully reduce the taxable value of a gift or bequest while keeping the founding generation in control as general partner during their lifetime. Insurance, and specifically irrevocable life insurance trusts, form the final major piece of this liability defense layer. A life insurance policy held inside an irrevocable trust rather than owned personally pays out death benefit proceeds that are both estate tax-free and creditor-protected in most jurisdictions, providing liquidity precisely at the moment, at death, when estate tax bills and other obligations typically come due, without forcing the sale of illiquid assets like real estate or business interests to cover the bill. The common thread across every tool in this section: separate the person from the asset, legally and structurally, before the risk materializes. Trying to build this protection after a lawsuit is filed or a divorce has begun is, in most jurisdictions, treated as a fraudulent transfer and can be unwound entirely by courts. The protection only works because it was built in advance as a matter of routine long before any specific threat existed. Everything we've covered so far is the legal skeleton, but none of it survives if the next generation doesn't know how to run it. 5. Building an heir who won't lose it. Every structure discussed so far can be perfectly built and still fail because trusts and entities are administered by people and inherited by people. And people are the actual variable old money families spend the most quiet effort managing. The financial education of heirs in old money families typically begins far earlier and looks completely different from conventional financial literacy education. Children are frequently given small, real allowances, tied not to chores, but to demonstrated decision-making, required to budget, to save toward a goal, to experience the actual consequence of a poor spending decision, while the stakes are still small. By the young teenage years, many old money families introduce children to basic concepts of compound interest, asset classes, and the difference between income and capital, not as abstract lessons, but frequently through direct, small-scale participation, such as a custodial brokerage account the child partially manages under supervision. Crucially, old money families are also disciplined about what heirs are not given and when. It's a well-documented pattern across many of these families that heirs are frequently kept from full knowledge of the family's total wealth and from full control of trust distributions until well into adulthood, often not until their late 20s or early 30s, and sometimes later, regardless of formal legal adulthood at 18. This isn't arbitrary. It reflects a specific risk calculation. An 18-year-old with full knowledge of a 9-figure trust and no track record of financial judgment represents enormous liability exposure to bad marriages, to manipulation by outsiders, to simple immaturity that a family can substantially reduce simply by staging both information and access over time. This staged model is frequently formalized through what's sometimes called an incentive trust, a trust structure where distributions to a beneficiary are explicitly conditioned on milestones, completing a degree, holding steady employment for a defined period, reaching a certain age, or matching earned income up to a multiple. The trust document itself becomes an instrument of behavioral incentive, not just tax and liability planning. Beyond formal trust conditions, many families build informal governance structures around the heir development process. Family councils or family assemblies that meet regularly, sometimes annually, to review the family's collective financial position, discuss upcoming major decisions, and in the more sophisticated operations, formally educate rising heirs before they're given any real authority. Some families codify this into a family constitution, a non-binding but culturally powerful document laying out the family's values, its expectations of members, its process for resolving disputes, and its rules for who can work in the family business or access family capital. The Wallenberg family of Sweden, whose industrial and financial holdings have persisted across 5 generations, is frequently cited as an example of an unusually disciplined version of this model. A family that has historically emphasized the strict internal expectation that heirs must prove themselves through education and independent achievement before being welcomed into significant roles within the family's holding structures, rather than simply inheriting authority by birthright. The Fugger family of 16th century Germany, one of history's original mega fortunes, built through banking and mining, offers a much earlier version of the same instinct. A family that built explicit internal rules around training successors in the actual mechanics of the business before handing them authority, at a time when almost no formal legal or financial infrastructure for this kind of succession planning existed at all. 6. The cautionary case. When the architecture fails. To understand why all of this matters, it helps to look at what happens when a fortune has the capital but not the structure, or has the structure but not the discipline. The story of the Vanderbilt family is the canonical case study here, precisely because it demonstrates that raw fortune size offers no protection on its own. Cornelius Vanderbilt built one of the largest fortunes in American history through shipping and railroads in the 19th century. Yet within decades of his death, a substantial portion of that fortune had been dispersed across descendants who, by most historical accounts, largely lacked the trust structures, the governance discipline, and, crucially, the financial education that later families like the Rockefellers and Wallenbergs would build deliberately in response to exactly this kind of outcome. Lavish spending on estates, a lack of coordinated family governance, and a large number of heirs each receiving a diluted share, rather than a concentrated, professionally managed pool of capital, all contributed to the decline. By the time a large family reunion was held generations later, it's frequently noted that many Vanderbilt descendants were, relative to the founders' era, no longer part of America's wealthiest families at all. It's worth being careful here. The Vanderbilt story is often told with more narrative flourish than precision, and specific figures attached to it in popular retellings deserve scrutiny before being repeated as exact fact. What's better supported historically is the structural point. The family did not have, at the time, access to or interest in the kind of dynasty trust and family office infrastructure that became standard practice for the fortunes built and structured in the generations immediately after. In many ways, the Vanderbilt outcome is part of what pushed the Rockefeller family, building its fortune only a few decades later, toward much more deliberate structural planning from the outset. The lesson isn't that the Vanderbilts were uniquely careless. It's that fortune preservation is not automatic, is not guaranteed by scale, and requires the specific architecture, trusts, entities, governance, education, discussed throughout this video, applied consistently, and defended against every generation's temptation to skip a step. 7. The pattern behind all of it. Step back from the individual tools, the dynasty trust, the family office, the LLC structure, the incentive trust, the family constitution, and a single underlying pattern emerges across every family and every century we've discussed. Old money wealth protection isn't one clever trick. It's the compounding effect of dozens of small, boring, unglamorous structural decisions, each individually modest, made consistently across generations, defended with real discipline against the temptation to skip a step because it seems unnecessary in the moment. None of these mechanisms are secret. Trust law is public record. Family office structures are documented in legal and financial literature going back decades. The valuation discount rules for family limited partnerships are published in tax code and case law. What separates families who preserve wealth for 200 years from families who lose it in 20 isn't access to hidden information. It's the discipline to actually build the architecture before it's needed, and the patience to let boring structures do their unglamorous work across a timeline longer than any single person's lifetime. This isn't hidden. It's just never taught. If this kind of mechanism level breakdown is what you come to this channel for, make sure you're subscribed. See you in the next one.